since the beginning of 2022 and since inflation started being recognized as it wasn't being transitory, it became very clear that the job market was too hot, and a lot of what was driving inflation was wage inflation. While the Fed's rates have brought down growth, and we had two quarters last year of negative growth, the job market seems stubbornly high. Why is that, and what needs to happen to the job market here?
Yeah, no, that's a great question. It's quite the conundrum. It certainly makes this particular market different than markets of the past. The problem is for the Fed, and at least from the Fed's point of view, is if Americans have jobs and they have meaningful employment, it makes it very easy for them to continue to keep their foot on the gas pedal. So they can keep raising rates, they can stay hawkish, and the idea is that workers, us Americans, will be able to weather the storm because we have income and we have jobs. So there's certain job reports that are very, very important now. On a weekly basis, we have jobless claims. We'll get it tomorrow for the current week. That number has been very stubborn, around the 200,000 jobless claims per week. We really need to see that number get closer to 300,000 to really feel like jobs are slowing down, people are out of work, and we're just not trending in that direction yet. The unemployment rate is still very stubbornly low. We'll have to see that number get closer to 4.5% to start to feel comfortable again, or at least the Fed will, to start to feel comfortable to change their rhetoric to a more dovish tone. The Jolts, the job openings, 8 million is just simply too high. We need to see that number come down as well. So with all of these different reports coming in, on a weekly and monthly basis, the job market is just too tight right now, and the Fed, it gives them more ammunition to kind of stay the enemy, stay their course, stay hawkish, and keep raising rates until inflation comes down.
Well, we just saw Microsoft announce they're cutting 10,000 jobs today, which is terrible news, but hopefully that helps the Fed take their foot off the gas soon.
Well, very interestingly, we've seen massive layoffs across mega cap tech stocks, smaller tech companies. Unfortunately, tech companies make up about 3% of the workforce. So whereas these layoffs absolutely horrible if you're suffering through one of those as an employee or a family member of an employee at one of these companies, these jobs may not put a dent in the actual overall job numbers that the Fed is paying attention to. So I continue to see those as well. It's very interesting because it sounds like, yes, layoffs are happening, but on a broad scale, it hasn't happened to the rest of the economy just yet.
And it's a necessary evil. It's absolutely necessary. Is that what you're saying for this to?
It is. I mean, look, if earnings were to fall, like I said before, if earnings were to fall much faster and economic growth were to fall very fast, that certainly would motivate the Fed to become more hawkish. But the targets here are to have inflation come down, and if a job market is very strong and very tight, the Fed won't be highly motivated to switch their rhetoric to something more dovish.
Stonebriar Wealth Management, advisors for your life.
This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process described herein will be profitable. Investors may lose all of their investments. Past performance is not indicative of current or future performance. It is not a guarantee.